Let's talk some stock specifics, do a little bit of trading in a few of the favorite growth categories. Joining us, Francisco Bido is SVP and Senior Portfolio Manager at FM Integrated Alpha. And we're going to talk a couple groups here, two sectors and stocks in particular. Francisco, welcome back to the show because you got something you like, something you don't like so much. Tesla's up this morning, but it's kind of been stuck under $300 and far removed from many of its mega cap peers making all-time highs. Seems like you don't think they're going to catch up anytime soon.
Yeah, that's correct. I think they face pretty much structural headwinds going forward into 2024 and beyond due to increasing competition and the way that their supply chain and everything is very vertical integrated. So they're going to face that kind of headwind, as well as some consumers' concerns due to recalls on the Cybertruck and so on. So it's very early on for them. So I think the market got overexcited about them. I would sell, and buy them on a big pull down and on a significant pull down.
The Tesla story here seems to be pretty mixed because they certainly demonstrated production prowess on the EVs compared to GM and Ford this past year. But then to your point, too, just the financials are not as compelling as buying, a big cap, stable tech company that has been the favorite of investors the past year. So which part don't you like about it? Like, what's the biggest drag in your mind?
For Tesla, it would be the basically the competition. Facing the competition and the fact that in order to keep those margins, it's hard to keep those margins while they're lowering prices. I mean, it's just the basic economics behind it. So that they got that structural pressure that it's not going to go anywhere anytime soon. And you got to wonder, they're doing something significantly different than what they've done in the past, to merit a much higher stock share price. And it's not happening.
What's interesting is even after some of those price cuts, their margins are still better than Ford GM. So I guess that's not their competition. Are you talking about some of the other EV startups? Who's the biggest threat to Tesla in your mind?
Well, I would go into Asia, to the Chinese market, basically, and look at the battery makers and so on, and they can probably produce a lot more of the same with a lot more cost efficiency. So they're the biggest threat. It's a global market, and I think Tesla has to be the first one in the market, basically, with a compelling case for EVs and so on, to get a good market share. But at the end of the day, they're not going to go much further than that unless they can produce a $25,000 car in the U.S. and so on. And that's going to be hard to do that and maintain margins. Okay.
Margins right now are definitely a big part of the story, especially after all the labor stuff ate into Ford and GM. Tesla deserves some credit, though, for not dealing with all that. It seems like their employees are pretty happy.
Tesla's a great company, but I got to look at it from a different perspective. I got to look at it from the stock, from the share price, and see what it's doing and where it's going to go. So it doesn't negate the fact that they're a great company, that they've done great things for their employees, and they got a bright future. But in relative terms, do we want to invest in Tesla right now, or would I rather wait? I'd rather wait.
Okay. Hold that thought. Tom, all right, what's the approach for Tesla in a bearish trade? If you want to follow the commentary here from Francisco, I know you've built something around it.
Yeah, implied volatility at or near 52-week low. So what type of strategy takes advantage of that, where you can offset some of your costs on a bearish position without maybe just buying a straight out put? So I looked at an unbalanced or skewed put butterfly to the downside. If you think maybe over the next month that this thing's going to slide from the levels, I mean, the stock's still up 107, 108% so far this year. So if you think it's going to pull back, but you don't need a massive move to the downside, this type of strategy takes advantage of it. Going out to the January 19th, the monthly cycle that expires in 28 days, I'm going to look to buy one of the 257.5 strike puts. That's basically at the money. Sell two of the 245 strike puts, and then buy one of the 240 strike puts. So if you look at the risk profile of this type of trade, it sets up where, hey, anything below that break even of 253.75, if you pay about a 375 debit, break even is below the current share price, just ever so slightly, about 1.5%. where you don't need that big of a move to the downside. Now you can look at the risk profile here and see the apex of profitability is at or near that short 245 strike, but anything even below 240, because I skewed it a little bit, I bought basically a $12.50 wide put vertical financed by a short $5 wide put vertical that contributes to this strategy. That even below 240, it's going to be about a double as far as profitability on this type of trade. So this is it's a balanced view that, hey, if the market slides a little bit, we're at overbought levels. Tesla's a little bit overbought right now, and you think it's going to grind a little bit lower or even fall, pretty big. This type of strategy takes advantage of it because you're offsetting some of the costs on your bearish play.
Okay, and that's important. If it does have a big move, you get to capitalize on that.
You're
not
still
just selling
capitalizing.
Upside.
Yep.
Important that you own some of that downside too.
Yep. And by reducing risk, if you were just to buy the 257.5 strike put, that's going to cost you a lot of option premium, right, in this trade where your break even is going to be even lower. You'll have more downside profitability, but at the same time, if you think it's just going to grind a little bit lower from here over the next month, this is one of the ways to play it.
Okay. All right. Tesla bear trade. We do have something bullish, though, for a positive day in markets. Francisco, one of the big winners of the year. Palo Alto with the cool double in price, some more than that, up 115%. How do they keep that going next year?
Cybersecurity space, in my opinion, the trick is really innovation. And in that sense, they're the 600-pound gorilla. They are the top of their game. They just released their Strata platform, which is the first AI infused security tool out there. So, that kind of innovation is it's what matters in that space. It's about us staying one step ahead of the hacker. So I think they're in a prime position to do that. They have the reputation. Unlike another company that I might mention or not later, who was breached, they have not indicated it. They haven't been breached or anything like that. They maintain a stellar reputation. So I think they have what it takes to succeed going forward.
Okay. The competition here, there certainly is a lot of it in the cyberspace, but you don't view that as being a threat to them?
No, well, let me qualify that. Competition is always a threat, but it depends on, who are you as a company? And Palo Alto has demonstrated that they can innovate. And as I mentioned earlier, it's all about innovation. If you can innovate, you can stay one step ahead of the game, or at least catch up with it. True. So competition needs to do the same, and I don't see them doing the same. So Palo Alto's one step ahead.
Okay. You like Palo Alto, you like Datadog. Okta, I guess, has spoiled their role in the market after their own missteps. So you've got to sell on that one. All right, like the specifics on the sector. Thanks, Francisco. Appreciate it.
Always.
Thank you. Tom, all right. How do we trade to the upside? Just buy calls and let them ride?
Oh, you can do that, but that's also got a lot of extrinsic option premium, right? Just buy an at-the-money call, say the 300 strike call out in January. You're going to need a pretty big rise in the shares to get that extrinsic value out of it. Remember, if you buy a call, even if the stock creeps higher, there's no guarantee that you're going to make money because you're paying option premium on that based on the duration that you have. The further out, the more you pay. So I looked at something in the maybe stock replacement, but not fully. I looked at a call diagonal here in Palo Alto. As you mentioned, stock's up 115% this year, just below all-time highs of $318 that we hit last week. So we looked at a call diagonal, short time frame duration, going out to the January monthly cycle, so 28 days to expiration. I'm going to buy that 300 strike call. And then to offset some of the costs on that, I'm going to look at selling the December 29th weeklies that expire in just 7 days, sell the 315 strike call. So a $15 wide bullish call diagonal to the upside. You're paying roughly about a $9.80 debit for a $15 wide call diagonal, so that's a bonus for you there. But you can see here from the risk profile, if I pay $9.80 debit, my break even's at or near about 301, so you don't need that big of a move to the upside to get above that. The apex of profitability is at that short strike. But as you get closer to expiration on the December 29th options that you're short on the 315 strike call, you can adjust or roll those to another weekly cycle, collecting credits, increasing that potential profitability, lowering that risk that you have in the trade, which is the debit that you paid on it. So this is a slow creeper trade to the upside towards that 315 strike, which is just below those all-time highs. But with the duration of only a month, maybe that's a little bit more conservative, where you think, hey, it's going to go higher, but I don't expect it to go to new all-time highs.
Okay. All right, like that. All right, fair enough. But so far, it's paid to have leverage on Palo Alto. Okay. This morning a little bit sluggish, even though the market's firming up here. Thanks, Tom. Thanks, Francisco Bido.